Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
Investors have a lot of questions. What happens to the stock market after it hits an all-time high? Is cryptocurrency a real investment? Where are interest rates headed? Hi, I'm Courtney Scott with Dimensional Fund Advisors, a global asset management firm that brings financial science to the world of investing. To help answer investors' pressing questions, we've compiled 5 of our most popular episodes of The Informed Investor. Now let's get started.
Welcome to The Informed Investor. Today's topic is all-time highs. I'm Mark Gochner. I'll be joined today by Jake DeKinder. And Jake, this is a topic you and I have a ton of energy around when we start reading headlines that bump up to all-time highs.
Where is your little soapbox that you get on sometimes? Because this would definitely be one of your soapboxes.
This would be one I would put right here.
Completely. But no, you're right about this. We read these articles about all-time highs, and then investors are reading this and saying, well, should I be invested? Should I not be invested? Should I stay invested? And I think people get a little bit riled up when they read those articles.
All right, let me read a couple headlines here, and then we'll talk about how to make sense of some of these. First one. The stock market has a secret weapon that's powering record highs. The stock market has roared back to record highs. What to do now? All right, let's start with the secret weapon. What's a secret weapon?
I think the secret weapon is some form of probably capitalism, people wanting to do well, companies wanting to do well, figure out how to bring products and services to market. So I don't know if that's really like a secret weapon, but that's probably what they're referring to there.
I'd almost think about it. It's a powerful weapon.
Yes.
Meaning I have a desire to make money over time with my investments, and the market provides a great mechanism as a way to do that. But bringing it back to all-time highs then, I think one of the frustrations we have with a lot of these headlines is it sort of gives you the sense that, okay, we come up to an all-time high, and that's a frozen ceiling. Like, you can't really get above there, so once you get near it, it sort of means, oh, hey, bad things are going to happen. You might lose some value in your investments. And I get frustrated with that because I do think a lot of investors read those headlines and probably make some decisions that may not be in their best interest when they try to start timing the market around record highs.
Think about the classic line with investing: buy low, sell high. And what this is doing is sort of flipping it on its head and saying, wait, am I buying high? Is that the right way to do this? So again, I said a couple episodes ago, sometimes I don't fault investors because sometimes there's like this intuition where you're like, yeah, that makes sense. Why would I want to buy an all-time high? But when you actually go and look at the evidence, there's nothing that says hitting an all-time high should give you pause about expecting to make money going forward. And by the way, thousands and thousands of all-time highs we've hit through time in the stock market.
Well, maybe there's a different way to position the idea of an all-time high. How about this, for example? Let's say I got an investment for you. You're an investor. I'm like, Jake, listen, I got an investment, and here's the deal. It's never going to go higher than where it is today. Are you interested?
You'd have to be a great salesperson. Be like, I got it for you. You'll never make money. Like, oh yeah, I'm totally in on that, right? But that's not the case. And what you're getting at there is that at all points in time, whether at an all-time high or whether we're down in the markets, the stock market's priced for a positive expected. Investors are expecting for it to go up over time. Otherwise, they would not be invested.
Yep. And you have some data around that. We're going to look at here in a moment and what that looks like when you're at all-time highs and when you're perhaps much lower than all-time highs. But it would be weird as an investor if you never had all-time highs, because all that is simply meaning I've had a positive return on my investment. So if I bought something for $100, then it goes to $105, and then a year later it goes to $110, that's an all-time high. That just means I had a positive return again. So we like to highlight some of those headlines there. Just be careful about it when you read about all-time highs, because we also hear other things get a little emotional in headlines. For example, it's the worst since, or it's the best return since. There's always something that kind of gives you a sense of, should I make a change in my plan as an investor? So let me read a couple other headlines as we get into sort of a different way to think about some of these all-time highs. So here's one here. A 2-month rally pushed the stock market to record highs, but watch out for these risks in July. Exuberant investors ignored turmoil at their own risk. So those headlines sort of bring in, though, this idea of uncertainty, the risk of investing in stocks.
ask yourself a question as an investor. Why do you get a return? What's the fundamental reason we get a return? And we bear uncertainty in some form. This idea that, there's risks on the horizon, or we need to watch out, that's always there in the market. It's the future. We have no clue what's going to happen in the future. We don't know how markets are going to react to future events. And that's the uncertainty that you take on. If you don't want that, you can go into an investment like treasury bills, right? I mean, there's a reason that they call it the risk-free rate. And that's because you're not really taking on very much uncertainty by going into that. And actually, that's perfectly fine. I would not beat an investor up if they said, hey, I'm only comfortable being in T-bills. You just have to adjust your expectation of what your wealth may look like over time and what that means for what you're trying to do with retirement and planning and sending kids to college and all of those things, right? I mean, and that's just a trade-off that you're welcome to make as an investor.
When it comes to investing in stocks, you have to have the proper horizon. Meaning, if I'm investing and think, well, I'm just going to see how it does in the next year or two, that's way too short of a horizon. There's an article that came out in 2022. And that was a tough year in the market.
It was.
And I remember this one because it was interviewing an investor, and she was talking about how concerned she was because the money she had to pay for her daughter's wedding later that year was all in stocks, and it took a big hit, and she wasn't sure how to pay for the wedding. So you have to have proper time horizons in mind when you think about investing in stocks.
Yeah, I mean, look, we're not here to say what's the exact perfect horizon for being in the market, but I do think you want to take much more of an intermediate to long-term perspective when you're going into the stock market. You want to be thinking in terms of 5, 10, 15, 20, 25 years. And in that example there, right? I mean, if you have spending needs that are coming up here in the next 3 months, the next 6 months, the next year, you got to pay for a kid's college, you're saving up for a house, it's a wedding, whatever it may be, right? You got to be careful saying, well, that money's over there in the stock market, because as we know, over, a 3-month, 6-month period, you can get some major drop. I mean, again, go back to a couple of months ago and look at what took place back in April, right? I mean, in 2 days, we're down. Right. I mean, that Thursday, Friday was crazy. And then it comes back the next week, and this is all the talk around tariffs. But that gets into the planning discussion. And to your point, when you're going towards the stock market, you want to extend out that time horizon and be thinking in terms of long terms, because you actually can get some decent runs where you get multiple years where you have negative returns in the market. I mean, we can show 10-year plus periods where stocks are negative, right? And you have to be prepared for that. And that, again, is that uncertainty we're talking about.
But over long periods of time, decades and decades, it goes back to, again, the idea of record highs. We have hit, I don't know how many, thousands of record highs over time, but you can continue to see that value increase and increase over long periods of time. It's just a return on investment.
You don't even need to put numbers to it. If you look at just a classic growth of wealth chart, and again, we've got 99 years coming up on 100 years of data, as we always talk about, it tends to go up and to the right. I mean, if you just look at that long-term visual. Now, if you zoom in on any part, sure, you're going to see volatility. I mean, we just referenced April, right? I mean, big swings up and down. But as you zoom out and you have that longer term perspective, man, that growth of wealth up and to the right. And that's what we're talking about there, of sticking it out through the all-time highs, through the uncertainty, through all the things that you're reading. And that's how you capture the long-term return.
You do have some numbers at all-time highs. You have some numbers, maybe at some tough time periods too. In numbers, I mean, once we get to that spot, what did the market do in future subsequent 1, 3, and 5 year returns? So give us some of those numbers. It helps kind of put in perspective how to think about these periods at all-time highs.
If you look at U.S. stocks, 99 years, and you say, what I'm going to do is every time I hit an all-time high, I'm going to look out 1 year, 3 year, and 5 years. On average, how do I do? And 1 year out, it's 13.7%. 3 years out annualized, it's 10.6%, and 5 years annualized, it's 10.3%. I mean, really, good.
I think that surprises a lot of investors.
That surprises a lot of people. Now, if you go to the other side of the coin, this is interesting too. If you say, well, now I want to look at every time I'm down 10% or more in the markets, how do I do 1, 3, and 5 years out? 1 year out, you're at 11.7%. 3 years out, you're at 10.3% annualized, and 5 years out, you're at 9.6% annualized. And, again, if you look at the long-term return of U.S. stock markets, it hovers right around 10%. I think it's 10.4 exactly. But, whether I'm looking at that all-time high of 10.2 or I'm down 10% or more, 9.6, all of those kind of start to look like the long-term return of markets. And by the way, if you sort of play that game and say, hey, let's go out longer, it all kind of starts to gravitate right towards that long-term return.
When again, I think it's surprising for investors. They probably expected much lower returns at highs and much higher returns down lows. But to me, it highlights sort of this pricing mechanism in the stock market, which is, hey, every single day, really at any point throughout the day, that stock has a positive expected return into the future. And, at Dimensional, we use the word expected return all the time because you just don't know into the future. But on expectation, there's a positive return. Otherwise, nobody would be buying that particular stock. But let's go back to one of the first headlines we read, which was what to do now. So it kind of gets into the idea then of what do? You execute the plan. Right now, if you don't have a plan in place, get with a financial professional, make sure you get something that's sort of tailored, customized to what your needs are and what your goals are when it comes to your money. But talk a little bit about how to think about that plan and have sort of those expectations in place.
You and I discuss this all the time. I mean, it's like the classic fire drill principle, right? I mean, you don't go through the fire drill when the house is on fire, right? You go through it ahead of time so that when something does happen, you're prepared and you execute the plan. When you get on a cruise ship, they don't show you where the lifeboats are when the boat's going down. They do all the pre-checks and they show you everything and they get you prepared so that if something happens, you jump into action and you execute the plan. And I think you want to have that mindset with markets too, which is when big drops come, when volatility comes, when I get a little bit emotional because I'm experiencing something, I'm reading something, I'm going through something, rather than letting that take over, you want to jump into action and you want to execute the plan. And I think for a lot of people, it's sticking with the allocation, sticking with the plan you put in place. Because again, markets will drop, but what we've seen over time is that markets do tend to come back and they also reward the people that executed their plan.
Yeah. And execute the plan with, I'll say, a calmness to it. That's why you do the drill. That just jumped out to me as you were describing that. If it's not just knowing what to do, but you're doing it in a calm manner, which means in this case, sticking to your plan, staying disciplined in the market, right? And not getting emotional and making a change.
You talked about working with a financial professional. I mean, think about that. Think if you are emotionally ready to execute the plan and you're willing to go through those actions, and then you put yourself in partnership with, you get together with a financial professional, and now you've got this trusted person who's kind of helping guide you through it as well. Now we're talking about a good recipe for success.
Okay, I'm going to summarize a couple things here as we think about all-time highs, and then you just add anything to it. I think first of all is there's been thousands of all-time highs. There could be thousands into the future. It's just a positive expected return on your investment over time. Be careful when you read some of the headlines. They are designed to get a little bit emotions going. It's not just record highs. It's also, hey, the worst and the best sense and things like that. So what do you do when you bounce around all-time highs? Just stick to your plan because the research shows there's positive returns into the future on average over time. So stick to your plan and try to execute it best you can and in a calm, as little emotional aspect as you can.
I think that's perfect. I mean, the only thing I would add is don't take the investment opportunity from Mark that's not going to make any money over time. Don't try to sell me on that one.
Yeah. Somebody says, hey, it'll never go higher. Stay away from that one. All right. Last thing here, Jake, you talked about kind of markets can have some pretty big swings up, big swings down. You highlighted a couple of those examples a couple of months ago. That's going to be a future topic here on Informed Investor. We are going to get into kind of volatility and how to think about volatility in the stock market on a future episode. Thanks for joining us today and have a fantastic rest of the day. Welcome to the Informed Investor, a show brought to you by Dimensional Fund Advisors, a global asset management firm bringing financial science to investing. Today's topic is a reflection on Black Monday, the market crash of 1987. I'm Mark Gochner, and I'm joined today by Jake DeKinder and Wes Krill. Now, guys, a couple things here. When we look at Black Monday, that was October 19th, 1987. And remember, we were prepping for this. I go, now, what day was that? Black Monday. Oh, yeah, that's right.
You got there eventually, man. It just takes you a couple extra seconds.
Slow.
I still thought it was a sale at some retail shop, like Black Friday.
That's Black Friday.
That's Black Friday. Okay. That's right.
All right. Black Monday. So Monday, October 19th, 1987, markets were down around 20% that day. So just imagine that. You got $1 million in stocks. In the end of the day, you've got $800,000. Like massive, massive drop. What do you guys think about a day like that in the market?
Well, fortunately, I was busy gluing macaroni on construction paper because I believe I was in kindergarten that day. But I mean, it seems like in my experience from watching the movie Wolf of Wall Street seems to indicate that was a very rough day in markets. And just looking back at this, so this is crazy. If we go back to July of 1963, so we got this daily return data for FAMA French indices, that was the 15,625th worst day out of 15,625 days over that stretch of time. So that's a pretty rough day in markets.
Yeah. What do you remember about that day, Jake?
My family's been in the business for a long time, so I do remember it was definitely a stressful period during that. But yeah, I mean, look, I think a 20% drop, you lose 20% of your wealth in a matter of one trading day. That's going to impact you. By the way, a week later, you had another actually massive down day in the markets as well. So kind of that whole month looked pretty rough. Now, we should note, the markets were up pretty big leading up to that. You know, markets look pretty solid coming through the first half of that year into summer, but then you get a lot of, news that's coming out. We get sort of a revised estimate of what our trade deficit is. You get comments about potentially trying to devalue the dollar. There's a lot of factors that are going on, but I think it's always interesting that people anchor to that one day. They anchor to the 20%, but there was so much going on around that.
Yeah, before and after that.
Before and after.
For sure.
Completely.
All right, let's hit a couple headlines here.
Yeah.
And then we'll dive into this a little bit deeper, talk maybe potentially some causes, lessons learned, some things like that here. But let's hit these headlines. Okay. The first one, Black Monday, the improbable crash, its causes, and timeless lessons for investors. I feel like I just said that one.
I just said that.
I just said that. All right, here's the other one. Black Monday, question mark. Black Monday. The S&P 500 is crashing like it's 1987. Now, here's the deal. I didn't tell you I was going to read this headline, so I'm going to make you guys pick the date. When do you think this headline came out? Black Monday? The S&P 500 is crashing like it's 1987. What do you guess? What date do you think that headline came out?
I think I'm going to go recently. I'm going to go April of this year, where we get a big announcement on the Wednesday afternoon, Thursday, Friday, and it's still rough into that next Monday.
My inclination was to go COVID, but I don't think people would have been joking about it back then. So let's go with the .com meltdown back in 99.
Jake, I don't know how you did it. Spot on.
Oh,
April 8th. April 8th.
You guys spend too much time reading news. That's your problem. You got to get your hands dirty in the data, and there's no time to read these news headlines.
I get confused by the data. I'm a better storyteller.
Well, compare those couple days. So we had those 2 days around the tariffs liberation day.
Yeah.
Wasn't it? Market was down around 10% over those 2 days.
I think so, that Thursday, Friday. Yeah.
Right. And then again, Black Monday is 20% in one day. All right. One of the reasons that we want to reflect on Black Monday is it's coming up here in a couple of days. I think there's a lot of investors out there, probably a lot of financial professionals too, perhaps younger in their career, that haven't gone through a major event like that. Because think about that for a moment. We did have COVID. So that's not too long ago, where I think it was the biggest drop we've ever seen in March. But to go back to then a significant time period before that, you had to go back to the global financial crisis, right? In 2008, 2009. What is that? 17 years ago. So, somebody 37 there in college, probably that time. I probably don't remember too much about it if you're chunking away in college. And then the crisis before that, the big one, would have been the tech bust. That's what you're alluding to there, starting the century in kind of 2000, 2001, 2002. And then before that, you had Black Monday in 1987.
Yeah, 97, you got Asian financial crisis. So that one, got pretty choppy for a little bit.
It's some big ones. Yeah, I guess there's some big ones around there.
But no, you're right.
In the 90s. But, I guess on average, you look at that. On average, maybe every 10 years or so, you get some big drop in the market like that. But I think it is a good time to reflect on some of those big drops, lessons learned from that, and have proper expectations as an investor when these things happen, and what do you do about it as an investor? So for me, that's one of the reasons we want to highlight this show around Black Monday.
There were some elements around, program trading that were taking place, during October through that weekend, all of it. I mean, a lot of different factors were sort of circling around this. You actually can read more about it if you go to federalreservehistory.org, kind of gives a whole scenario. I do think it's helpful periodically to go back and look at these different events, what caused them. As we talk about a lot of times, it's not always clear what caused them. In hindsight, people love to look back and be like, well, it was X, Y, and Z that led to that. And while that's maybe one factor, normally there's like a series of factors around it. Real quick, the 87 one too is interesting in that we learned a lot about maybe how we might want markets to function as well. Because coming out of 87 is when you start to have some of the circuit breakers that are put in place that say, hey, if you get a drop of 7% or so, let's pause for a little bit. You get another drop. I think it's around like 13%. Let's pause for a little bit. And actually, if you get I think now, if you get a 20% drop, I believe that trading is halted for the day. So we always want well-functioning markets. My point there is that we do learn as we go along of, hey, maybe there's some things that can be put in place that can help protect from a little bit of that sort of feeding upon itself of panic selling that does take place.
Yeah, I mean, the fact that the market is dropping is probably an indicator that maybe the market got worse news than it expected. And so investors are no longer willing to pay the same price they were before. And so you do want that in a healthy
100%. 100%. Yeah.
You don't want to exacerbate it. So, when you have restrictions around like short selling and things like that have come into play over time, I think those are useful ways to keep the market well functioning while, still, again, not trying to exacerbate a crisis.
It's always a balance. And we're not here to, advocate for big time regulation. But I do think that there has to be sort of some checks and balances that are in place.
I find too that the press, and I think most investors, you want to simplify the world to say, well, this caused this. But it's not that easy. I mean, there's so many factors going on around there. I mean, you've probably done some reading around that. What are some of the things being talked about potentially that drove that day? Yeah,
whether the market went up or went down big time, it's usually hard to figure out exactly what was driving it. Sometimes there are things you can point to. I remember, I probably mentioned this story before, but the very first TV interview I ever did, so it was back in November of 2020, and I was meant to go on there and talk about the election results. Remember that was the Monday after that election spilled over to the weekend. They finally clarified that Biden had won the election on that Monday. And so I'm meant to comment on how there's not been a strong reaction typically from markets at the conclusion of an election. I look down and see that, for example, U.S. value stocks are outperforming growth stocks by more than 6% on that day. And you look what else was going on in the world that day. Well, that was a day where one of the big pharmaceutical companies had announced the success in their trials of the COVID vaccine. And I think everyone was starting to breathe a sigh of relief. And so on that day, you could probably say, okay, well, maybe this is what was driving the market's turnaround. But yeah, you look back historically at some of these market downturns, it was not necessarily obvious and you couldn't pin it on one particular factor. And that makes it hard to predict, right? We always talk about, okay, what is the likelihood that we think we're going to have a market downturn? A lot of people spend a lot of time concerned about that. It's very difficult to predict because even with the benefit of hindsight, you might not be able to say exactly why something happened.
Well, and also if you have the same facts and circumstances that was in place, 7 years later, 10 years later, whatever it is, the market might react to it very differently. And I like to point to, the first time U.S. debt got downgraded back in August of 11, in the U.S. markets, we get downgraded the debt. August and September are pretty rough in the markets. October actually came back pretty well. Now you fast forward 10 plus years later, we've gotten recent downgrades of the U.S. debt. And I mean, I don't want to say it was a non-event. It's still a big deal. But in terms of the market's reaction, it didn't look like it looked in 2011.
Well, you were getting into lessons learned just a minute ago. You can't really predict these major events or major days. So we'll talk about that. But just to set that up, going back to 1987. So we had that huge day. Jake, I think it was a week later, the market was down another...
I think it's the following Monday.
8-9%.
Yeah, something like that. It might have been 6 or 7, somewhere around there.
So you see this massive volatility in some of these challenging time periods, both up and down during those time periods. But the year ended positive for 1987. I think it was up 5.2%. For the calendar year. So again, going back to this idea, you go back and look over time and you think, well, it's a non-event that year. It was anything but. It just sort of ended up slightly positive for the year.
Same thing in 2020. Yeah, you get some of these big market downturns. Again, we always talk about the idea of staying disciplined, staying invested, because you don't know when these market drops are going to occur. But when they do happen, you don't want to compound the problem and then get out of markets and miss the rebound, because in some cases the rebound has happened very quickly after the single day drop.
Well, and we're talking about single day drops here, but I mean, do note that, and I think maybe we covered this in a previous episode, this is one that we like to talk about, that if you look, over the last 40 plus years or so, you get about a quarter of the time where you get a drop of at least 20% during the year, right? Now that's obviously not on a single day. These are like Black Mondays and out. We're talking, I get that. But it is good to note that, if you say, well, roughly about 1 in 4 years, at some point during the year, the market's down 20%, like that gives you some perspective of this stuff does happen.
Yeah. So there's a lot of volatility in markets.
Yeah.
Huge price swings. And we've talked about this before. Again, you want that to happen in a well-functioning market, constantly.
So we're getting paid the equity premium, right? And it's not to have smooth sailing. It's to bear the risk and uncertainty associated with stock returns.
So that's a big lesson. Another one for me is you just can't time it. But you just can't predict exactly when these things are going to happen as much as you want to. There's just no way to know around that. And I also think, too, about when you get into some of these circumstances that potentially, we're reading about things that could be driving that particular significant drop. Whatever you're worried about, it's already somehow reflected in the price already. So maybe it gets worse, maybe it gets better. Prices will adjust to that going forward. What are other some of the lessons learned from some of those major days?
I think just delving into that point you just mentioned, which is, the concern itself doesn't necessarily have to be resolved in the world for the market to have moved beyond that contribution to uncertainty. Like COVID-1 is a very good example where the market started to turn around very quickly after that March downturn. But that didn't mean that COVID went away. There were still concerns around that. It's just that those concerns were reflected in market prices. And it was really once you learn something new when markets would react to it. I think that's a good point. That's why it's so difficult, by the way, to predict these things, because you don't know what the news is going to be in the future by definition.
I think there's always maybe a little bit of concern about a looming crisis that's out there. There's a lot of stuff that's going on in the world. There's a lot of stuff that's going on in financial markets. And if you kind of search for it, you can always sort of the potential crisis that might be out there. And when you're in it, it does feel like a really big deal. But one of the things, we like to do is sort of ask people, be like, so let's go back to, 2020, you can remember it. Let's COVID, I got you. But you take people back to 2019 and be like, well, what was the major thing you were worried about back then? I don't remember. Go to 2018, 2017. But if you go and you start to look up some of the different events that were taking place during these years, it reminds you like, oh yeah, that was a really big deal. And in the moment, people were really concerned about it. You get 4 or 5 or 6 years out, you literally can't even remember what was going on.
There's always something to be
There's
worried
always
about.
something.
Always something to be worried about. I'm going to read you a headline here. Again, let's see here. All right. This one came out in July of this year, July of 2025. The headline is, what if this time really is different for investors? Now, I think in there, it's probably talking about AI, but let's go back to this concept again of like the Black Monday. Was it different?
Yeah, I think
absolutely.
I think it was. I mean, I think we've hit on this quite a bit that to me, it's always different, right? The events are different. There's no perfect blueprint. I mean, it's just the world's dynamic. A lot of things are changing all the time. I just come back to, even though it's different, should you do something different? And that's where I always land. We were talking beforehand. You were saying that, I think you're referencing COVID versus one of the other downturns that we had. And we said, well, yeah, but that one, there was a health element that was worked into it. You couldn't go out and see your friends or your family. You were kind of cooped up. So there was a social element to it as well. And yeah, that was really different. But from an investment standpoint, should you have done anything different? No, because that turnaround was crazy fast.
Yeah, that's a good point. Yeah, that definitely felt different at the time. Yeah. Unless you're in Texas or Florida where you can, start going out to bars and restaurants 2 months in the pandemic. But, everyone else was stuck at home. I know that was.
But I like to prioritize bars before restaurants.
Whichever one seems more irresponsible, sure.
Well, it does say, I mean, we talked about this, but unless you have a better solution, which we're not aware of, stick to your plan. Have a plan in place. Stick to it. Stay disciplined. Know your stocks or your long-term growth money, 10, 20, 30 plus years around that.
Well, go look up, all of these different events that we referenced there, right? I mean, go look what either an all equity portfolio or even a 60-40 looks like 3, 5, 7, 10 years after these major events, these major downturns. And for the most part, you look at those numbers and you're like, those are really good numbers. That would help keep me on track for my goals.
And usually those big downturns come back. It's been different over different times, but those things come back and, you get back to the conversation on all-time highs again.
That's right.
In not too far after that. All right, last question for you guys. Prediction. When's going to be our next 5% down day?
There you go with the predictions again. What did I just tell you guys? I'm not in the predicting business.
I have absolutely no clue. I do know that if you want to be an investor for the next 25, 30, 40 years, no guarantees. There's a decent probability you will see periods of high volatility. There's a decent probability that you're going to see some massive drops in the market. Maybe it takes place over a month. Maybe it takes place over a single day. But hopefully a lot of the things that we're talking about here, you come back to and be like, yep, we've seen that before. And I do know that for the most part, markets tend to come back.
Yep. If I could predict it, it would be sort of like that experiment you ran back in the day, the perfect market timing strategy, where you would grow $1 into like tens of billions of dollars if you just knew when the market downturns were going to happen. So I wish I did know. I could be very wealthy really quickly.
We should bring that perfect market timing onto this. Those numbers are so fun.
Yeah, let's do that as an episode.
It'd be great.
It's unbelievable. If you were able to get it right.
That's right.
The wealth you can create. All right. So that was October 19th, 1987. We are in October now in the fall. And one of the topics that comes up quite a bit this time of year is looking at taxes. And by that, I mean, most asset managers are going to come out with their estimates, their year-end estimates for distributions for their stock and bond funds. So it leads to that conversation of, hey, how do I think about tax efficiency as an investor? What are some of the key concepts I want to keep in mind there? So let's come back again here on our next episode and dive into taxes.
You're going to totally geek out on that episode, Doctor.
I'm going to love it. In fact, we're going to switch shares, I think, on that episode here.
I think I have a prior commitment that day. I don't know when we're recording it. I think I'm busy.
All right. So thank you, everybody, for joining us here today on The Informed Investor. Be sure to tune in on the next episode where we are going to look at some tax efficiency. And with that, hit subscribe and have a wonderful rest of the day. Thank you. Welcome to The Informed Investor. Today's topic is managing downside risk in your stock portfolio. I'm Mark Gochner. I'll be joined today by Dr. Wes Creel and Jake DeKinder. Guys, I always like to start with a couple of headlines, and then we'll dive into it here. So 2 headlines. The first one, buffered ETFs protect against market drops. They're selling like hotcakes. And then the second one, buffered ETFs do their job, but are they worth it? So some great headlines here to open up the conversation. Maybe we start with the hotcakes.
What is a hotcake?
Well, I think we decided it's the same thing as pancake.
We did. I think we looked that up, right?
Yeah. I don't know why we need so many different ways to describe like a very bland, basic food, but here we are.
I think we also looked up that going all the way back to prehistoric times, this has been a staple of human diet. But we don't know what they called it.
That was a pancake back then.
Well, I mean, did they call it a pancake? Was there formal language back then?
All right. It does reference, though, the buffered ETFs. So, Wes, let's start with you. Just give us a little bit of overview of kind of what buffered ETFs and how do they fit into some of these broader strategies we hear about with minimizing downside risk.
Well, and first of all, the idea of minimizing downside exposure sounds great. So you can imagine the appeal associated with these. And to your point, they've been very popular this year. I've seen $38 billion in terms of net new flows to the categories that would be categorized that way in terms of downside protection. 97 new ETFs that have already been launched this year across those categories. So again, it's just a general class of investment strategies that really are seeking to minimize their downside exposure to fall less than the broad market, I guess is the way you would describe it.
Well, and it's really nothing new, I'll say, in the industry. I mean, what are you doing there? You're really managing the emotions of an investor. You're kind of managing fear and greed is what these strategies are designed to do, right? I mean, it's very appealing to say, hey, I'm going to help you out and I'm going to protect you on the downside, but I'm going to still give you some of the stuff on the upside. And we'll go into some of the details on it. But these types of products of I can design basically a service for you to manage your emotions, that's been around for decades in this industry.
Well, I like how you said it's nothing new, but go back to maybe some of the reasons why it seems pretty popular right now. I go back to 2022, which is a really tough year for investors. You had stock market was down here in the U.S., bonds were down. So a really tough time period when both of those were down significantly. A lot of times people think, well, when stocks are down, bonds will do well. So I think part of it is that maybe somehow things are different because of that 1 year's experience. You still hear a lot about all-time highs. And that gets people a bit nervous. And we just did an episode about all-time highs. So folks can go listen to that one.
Nice promotion.
As well. Yeah, great promotion there. And then, part of these categories can kick off some income. And some people think, well, hey, I can get downside risk, yet I can still get some income in a portfolio. So, Jake, it's kind of what you're saying there. It's marketed as a way to solve a lot of these different needs. But let's dive into it a little bit here and think about, are they really efficient at what they're supposed to be doing? And are there other ways to think about minimizing risk?
Well, and the risk thing is really key here because just because you're invested in these strategies doesn't mean the risk goes away when it comes to stocks. Somebody's holding these stocks, somebody's bearing the risk. So you can think of these as maybe being approaches towards transferring some of that risk to someone else. Now, people might be willing to do that, but they're not going to do that for free. And in fact, the costs associated with that is likely to vary depending on what the circumstances are. We know from looking at options pricing data that when uncertainty is higher, The options markets are going to give you a higher price to transfer your risk. And so, those are going to factor into potentially the performance of these. And I think that makes 2025 so far an excellent test case, because we did have a big market downturn back in April and then a really quick rebound. And so you're thinking about not just, what is the possibility that can stem some of the downside from markets, but then what am I giving up in terms of upside participation? Is how is that going to come back to bear itself when there's a rebound?
Well, you're talking about there's risk that has to be borne. Who's going to, and what are they going to charge you to do it, right? Obviously, the other side of that is there's return to be had, and who's going to walk away with that. So almost as an investor, you kind of have to push yourself and say, so wait, someone's going to allow me to get like some type of better return for a lower price, or they're going to do it for free. Just remember, everybody in this industry is a for-profit player, right? And there's return that is going to take place out there. Ask yourself, an investor, who walks away with the return.
I think about that transferring risk. It's like home insurance. I mean, we get it. Somebody else is bearing that risk, and then there's a cost to us for them to bear that risk here. But Wes, let me read a couple different categories here, and I'll get your thoughts, and maybe just give us an overview of kind of the way that they try to manage risk here. So I think the buffered ETFs would fall into a category called defined outcomes. There's equity hedged. There's derivative income, some of these different categories in Morningstar. But ultimately, I think they're trying to accomplish the same thing, which is minimize some of that downside risk. How do they do that in those different strategies?
Yeah, without getting into all the technicalities of it, you're using different kinds of options, with buying some and then selling others to potentially stem the losses if there is a falling market. It's not a guarantee. These are still investment products, but what it means is to a certain point you might mitigate some of the downside of the portfolios. But then there's that combination of the different options, which means you're probably going to be giving up some of the upside. And I think, again, investors have been trying to balance their participation in the upside with the potential for downside for as long as we've had investments. I think that's one of the appeals to having a potential balanced type of strategy where you have equities and fixed income that's meant to achieve a similar outcome. And I think the development here is people are trying to do this within the equity sleeve of their portfolio. And then that remains the question of, is that the most effective way to get your downside protection?
Jake, you were talking about earlier this idea of ease of access. Mm-hmm. And how in the past maybe it's a little more difficult to go get some of these different strategies, but now with some of these ETFs, you can just go out there and buy it pretty quickly.
Well, that's just it. I mean, go back to, the old fixed annuities. Go back to the old structured products where, you have some type of fixed income return and I get a derivative overlay on it. And I basically can sort of try to define what I want that outcome to be. What we have seen, and I think you referenced this in terms of the flows, now what you've moved from is, I don't want to say a product that maybe was hard to get, but maybe the ease of access wasn't the same as when it's traded on an exchange in an ETF vehicle, and maybe marketed a little bit more to investors. And listen, this ease of access to investment options, I think that's actually a really good thing for investors, but you have to know what you're getting. Just because it's packaged in an ETF format doesn't mean that there aren't risks associated with it. And no matter what, you got to understand what it is you're investing in, and is it the best way to accomplish your goals?
Well, one of the things we talked about is there's a cost to going out there and getting this insurance. Let me read a couple numbers here for you guys. And I'm going to highlight the three categories that we just talked about, just because it sort of covers a lot of those different strategies. Now, this is the expense ratio. So the cost of the shareholder, what they're paying these different entities to do this. So the derivative income category, the median expense ratio of all those different funds in there is 97 basis points, or 0.97%. The equity hedged is 1.07%, and the defined outcome is 0.79%. So expense ratio is larger than what we see in, I'll say, the average mutual funds that are out there. But let me highlight some of the returns as well. And I'm just going to go back the last 3 years. It's an interesting time period where you go to 2022, which was that challenging year. I think the S&P was down about 18% that year. And then we'll look at the following 2 years, which were some pretty good years in the market. So these are going to be cumulative returns of those 3 years, 2022 through 2024. The derivative income cumulative return is 21.5%. Equity hedged, 18.3%. Defined outcome, 20.7%. So those are three good numbers there. But if you look at the S&P 500, cumulative return was 29.3. So it goes back to the strategy then of what they were doing. They certainly minimized the downside in 2022, but they missed some of that upside, or gave up some of that upside in the subsequent 2 years. So it doesn't necessarily seem that it could have been the best solution, perhaps, over that 3 year time period.
Well, they're striking a trade-off. And I think, again, whenever you think about whether something's appropriate for your asset allocation, there's a number of things you might evaluate. But one of them is, am I getting something that I can't get elsewhere? And if I'm not, then you start to think about those expense ratios, right? So we already talked about the idea that you can sacrifice some of your upside by taking a little bit less on the downside with equities and fixed income. Well, we know that can be done relatively inexpensively. And so when you talk about those expense ratios, you might say, well, is this worth the additional cost, potential additional complexity in something that I may or may not understand versus just stocks and bonds if I'm not ultimately getting a better outcome over the long haul?
You brought up insurance, right? I mean, people complain all the time about their premiums going up, and there's reasons for that. We don't need to get into natural disasters and all of those things, but that's the reality, right? People are like, is it worth the cost? Man, these premiums are getting really high. And I think for some of these products, you want to think about it really kind of the same way.
One of the things that we talk a lot about, and there's a framework here, we use it, Dimensional. It's really effective to evaluate any investment that you're considering. Now, Jake, walk us through just those 4 parts here, and then we can kind of see how some of these different buffered ETFs might fit in.
This is something we've talked about for a number of years now. I mean, Gerard, our co-CEO and CIO at Dimensional here. I just think it's a great framework to think through really any time you want to put money to work. And the first question you want to ask is, what's the goal, right? Like, what is it that it's accomplishing for me as an investor? Next, you want to be able to think about what's the expected return, or, in plain English, what do I think I might make on this investment? Because, by the way, if you want to do any type of financial planning and scenario analysis, you got to come up with some expectation on what you think you're going to make. What's the risk that's associated with it? And that, by the way, for a lot of things goes well beyond volatility. And then what's the cost associated with it? And with the cost, you want to think about the expense ratio. You want to think about something like tax costs. And then you want to think about opportunity costs as well. That's one to always remember, because unless you have unlimited money, you're pulling money out of X and you're putting it into Y, and there has to be some form of an opportunity cost potentially associated with that. Those 4 questions are really good to keep in your mind as an investor.
It's great for any investment. And Wes, to me, it points to a couple different things here. You think about what's the goal of stocks. I think for many people, it's I want to grow my wealth over time. But then there can be a goal from another investment to help minimize some of that downside risk. And maybe that's where the conversation that brings in bonds. And how can you think about using stocks and bonds in your overall portfolio?
Yeah, that's, again, if you're trying to assess whether this expands your opportunity set, what other asset classes do you have already at your disposal that can help you balance sort of your upside versus downside? Like you mentioned, bonds. 2025 has been a good test case, like I mentioned earlier, because we had the drawdown in the broad market, but then the rebound. So if you look at the performance for a global 60/40 index, it actually outperformed these categories that we've been talking about, the defined outcome, the derivative income, and the equity hedge. And so I think that's, again, you go back to the expected return. What do I think I'm going to get from these asset classes? It's not clear that it's going to be a better way to do it, and then you factor in the costs. You mentioned taxes. That's another really good point, especially these categories that are throwing off a lot of income, like the derivative income category. As the name suggests, it tends to be a high yield set of investments, and a lot of times those can be taxed at ordinary income rates. And so if you look at the tax efficiency, basically how much of your on-paper returns are preserved after distributions, it's been substantially lower in recent years than a general equity investment category.
We're watching the headlines all the time. We've been doing this for a long time. We've seen a lot of products that are launched. And I'll tell you, over the last couple of years, when we're out there, we're talking to financial professionals, we're talking to financial advisors, we're talking to investors, you see sort of trends of questions that come, right? And we'll go back a couple of years ago. We got a bunch of questions about SPACs, right? And then we get a bunch of questions about meme stocks. And then more recently, we get more questions about private investments. Now we're getting questions about these buffered strategies. And I guess the way I think about that is when I start to see a lot of questions pop up from financial advisors and almost indirectly from retail investors, for me, it's a red flag, right? Because then I'm like, okay, now you've got something that maybe was designed or originally marketed to sovereign wealth funds, big institutions, foundations, endowment. Now it moved down to financial advisors. Now it's packaged for a retail audience. And I'm not here to say whether it's a good or bad investment, right? Anytime I see that trend, that is a red flag for me. And again, I think having a high degree of skepticism with the products that can be marketed to investors in this industry is a good thing to keep in mind.
I like the word skepticism. Just know exactly what you're getting into.
Look into it. Yeah.
So a couple of things jump out to me. One is you think about minimizing risk. If you're pushing that risk onto somebody else, there's a cost for that, for them to bear that risk. And I love the framework you walk through. I think for any investment, just go through those 4 things. What's your goal? Expected return, risk, and cost. And I think that helps give you a lot of clarity in terms of what you're trying to accomplish. And then the best way to accomplish that, which might just be, you got to look at your overall portfolio of stocks and bonds and whatever else might be in there. You just can't isolate it to one particular area like stocks. So what else would you guys add to that sort of key takeaways?
I think one way to think about it is if you're looking for a buffer, think about maybe you already have a natural buffer in your portfolio. And if you have periods of time where the U.S. stock market is down, most fixed income asset classes have been up on average. And so you might not have to look beyond these traditional solutions within your portfolio to manage that downside risk.
All right, great topic here today. And, we do get a lot of questions around minimizing downside risk of a portfolio. Another set of questions we get is also, how do I think about the safety of my money, overall risk of my money, who has it? What are some of the things that are in place? And by things, I mean policies and procedures from the SEC and other areas to make sure that I have comfort that my assets are safe. So that'll be a future topic here on The Informed Investor. Thanks for joining today, and be sure to hit that notification button. Have a great day. Welcome, and thank you for joining The Informed Investor. Today's topic is the granddaddy of them all, interest rates. I'm Mark Gochner. I'll be joined today by Jake DeKinder and Dr. Wes Krill. And I said, the granddaddy.
You're so excited.
I'm so excited. and maybe it's not the granddaddy. Maybe it's the daddy, the stepdaddy, something.
This sounds like a therapy session, Gochner.
Family issues. I mention it, though, because interest rates, they really do touch all parts of our lives, right? From savings rates to student loan rates, credit card rates, mortgages. It has a big impact on our lives. It's a big topic.
It's a huge topic. It's not surprising that people want to, I think, better understand it. And also maybe with something that's that important in people's lives, they almost want to feel like I have more control over it, or I have more control over what it's going to be in the future because it is that important in my life.
All right, I want to read a couple of headlines. Now, bear with me. These are a little bit longer ones, so I'm going to read them slower here. All right, the first one. Stock market melt-up is being fueled by blind belief in lots of rate cuts in 2026. And the other one I want to highlight. Stocks are in turmoil, but treasury yields are stubbornly high. I want to talk about that one, too.
You're going to get on your soapbox for that one.
First. I will get on that one. I do have a lot of soapboxes.
I like the blind belief comment, which actually may be almost the best investment advice ever, which is this sort of like trust your belief in markets and then maybe don't look at your money too often. So that actually may be great investment advice.
Interpretations are important on some of these.
The alliteration's really good too. As a fan of alliterative paper titles, I might have to steal that one.
All right, to melt up. Interest rates. There seems to be that forever quest, and probably stocks too, but the idea of I got to forecast interest rates, I got to predict interest rates as I think about my investment decisions. Wes, how do you think about the ability to predict what rates are going to do?
Well, you can see the appeal of it, right? When it comes to bond math, it's pretty simple that if the interest rate goes up, the price goes down. So that if you could predict when and how interest rates were going to change, that would be an incredibly compelling proposition for managing your bond allocation. I think what the data tells us is that prediction is not as easy to get right as it might seem.
Well, look at something like the Fed dot plot, right? There's just a great example where you have people that are working at the Fed who are literally in control of setting the rates, and yet where the dot plot is over the short, the intermediate, or the long term gets adjusted constant. They don't even know where rates are going to be, and they're the ones that are setting them.
Yeah, the Fed Watch tool on the CME Group's website. I don't know if you guys play around with it. Probably not you. You work on your golf game doing fun things, but I like to look on the internet sometimes at data like this, and it uses those kind of data observations to kind of pull together what is the aggregate expectation for what the Fed is going to do in the future, and it gives you an estimate. Which for this year, by the end of the year, the expectation is that the federal funds rate is going to go down to a range of 375 to 400 basis points. But the actual likelihood of that is relatively low probability, less than 50%. And the stuff around it, the other outcomes still have a pretty meaningful probability around them. So as you're far away from these kind of events, there's a lot of uncertainty about what can happen with rates.
And we should be clear, we're not knocking them at all, right? It's just the reality of it is that we don't know what's going to happen in the future. And it would be it actually, in my opinion, would be relatively wrong of them if they weren't updating their expectations based on new information that's coming in.
Well, you highlight some of these different sources you can go to. I mean, everyone's participating in this. So there's a wealth of information that's coming into these prices and expectations in there. And you're right about prices are constantly changing. And I think you've got a nice example there of how even within a day or two of the Fed trying to determine what to do with interest rates, things change very quickly.
Yeah, I mean, one of the things that the Fed has articulated they're sensitive to is the potential for inflation. And so their decisions around cutting rates can be tied to what they're observing in terms of inflation pressure. So, that data is constantly evolving. And there was a really good example back in February, I think it was February 12th, where there was a CPI report that came in, and the interpretation of it was that consumer prices had risen more than the market expected. So what happened to the expectation for future rate cuts? Well, that probability fell. But then over the next couple of days, you get additional data points about the economy, about consumer prices. You get the producer prices report. That one was not as high. And then you saw the retail activity, and it was maybe a little bit lower than what some people had expected. So the net effect of those three events was that the probability of rate cuts actually started to creep back up. So, to your earlier point, which is the reason why this is so hard to predict is because you would have to predict everything that's going to happen in the world, not just what the Fed's response is going to be to it. And that would require a crystal ball, which I have not yet procured.
Well, one of the things that you often hear about is, well, it's obvious rates are going to go up. Well, if it's obvious to everybody, rates have probably already gone up, reflecting that expectation across the market. The other thing I want to highlight, that comment about rates.
I'm so glad you hit on that. Yes.
Right. And you were just talking about the Fed funds rate, which is one rate. But there's sort of this idea that, well, every rate out there somehow has to follow exactly what the Fed does.
Right. And the only one they directly control is the federal funds rate. And, even if there's going to be a period of time where that rate is changing, you still might not be able to say exactly what's happening to other interest rates because they're driven by the market. So, 2024 is a great example where you had three rate cuts starting in September going through December. And over that stretch of time, the 10-year Treasury actually went up. The yield on the 10-year Treasury actually went up. And so this is not uncommon, by the way, when we look at months where there has been a decrease in the federal funds rate, a third of the time the 10-year Treasury yield went up. So it's like, even with the benefit of hindsight, if you knew that in advance, you still might not get your call correctly on the bond market. And that's relevant when you're thinking about your portfolio's positioning, because there's hundreds of rates out there in the marketplace. And it's not just the federal funds rate that's going to drive the performance of your bond allocation.
It's interesting on here's what the Fed's going to do, and this is what's going to happen with all rates, or we have sort of this correlation, or I can use it to predict, or I can do all of these things. Ask yourself that, if you could reliably predict what was going to happen with interest rates, like if you had the secret sauce, and would you tell anybody about it? So when you see a lot of these predictions about like, well, here's what's going to happen with either the Fed's fund rate or rates in general, just take a step back and ask a logical question. Does anybody truly have that information?
And it's a good point there that we're not being flippant about that. But it's really a logical comment that if you really had that ability, of which there's no evidence anybody does, you wouldn't tell a soul, right? You would just trade on it yourself. So I think it's a really important point to keep in mind. Same thing on equity returns too, stock returns. But what about on the equity side of things? What happens when the Fed changes interest rates? How does that impact stock returns? And Jake, we got some data around that one as well.
Yeah, if you kind of carve it up into sort of three categories of when they hike, when they cut, or there's no change at all, and then you look at the monthly returns of the broad stock market in those months, in all three cases, it's right around 1% or so per month. A little bit higher returns when you get a cut versus a hike. But in general, it's right around 1% or so. And then you ask yourself as an investor, regardless of what's going on with the Fed, regardless of what's going on with rates, would I want a 1% average return per month in my stock portfolio? I'd be like, yeah, that's how you capture the long-term return of markets.
Yeah, I think you're hitting on a key point, which is, and you use the word flippant, which I really like, which is when we talk about this data where we don't see a strong correlation between the returns of different asset categories and things like the federal funds rate changing. It's not because market participants don't care about this or it doesn't impact maybe the future cash flows of certain kinds of businesses. It certainly does to an extent. I think what we're saying is that the market in many cases has already factored this in, because in instances like the Fed changing the federal funds rate, they tend to telegraph what they're going to do. And so market participants have an opportunity to set prices ahead of the actual event. If I think back to 2022, there was a good example of this where there was a very drastic increase in the federal funds rate on June 15th that year. And what you saw was the commentary around what they intended to do was pretty unambiguous ahead of time. And so the Treasury yield curve moved up days in advance of the June 15th rate increase. And so on the 15th, when they actually changed rates, there was very minimal response from Treasury yields.
That communication's also increased quite a bit over the years. We had a professor come in, remember last year, doing a lot of research around this and just sort of the communication that the Fed has, the path they've gone down in the last, I'll say a couple of decades, and it's definitely increased. And I think that's to your point there of there could be more information that's out there in the market. So when the actual decision comes out, a lot of times the market may not be that surprised by it.
Could be old news. And if it's old news, probably can't trade on it.
It's a great point on both those examples of how the market, I'll say collectively, I mean, they're on every word the Fed talks about or looking at any numbers out there, trying to anticipate and price in, expectations of what rates may be in the future. So let me ask you this. When you mentioned 2022, and that was a year where stocks were down significantly and bonds were down significantly. And you read in the headlines quite often about, well, bonds are great because they're kind of a buffer to your stock portfolio that, hey, when stocks go down, your bonds usually hold up. They're pretty stable. I think on average, that's true, but we use that term on average. It's not always the case. I'd just love to get your thoughts, Wes, on kind of how to think about that relationship.
That was certainly an outlier when we look at the historical data. That, in fact, I think that's the only time where stocks have been negative. The S&P 500 was negative for a year, and government bonds were negative. I mean, it was just really across the board. Typically, in years where the S&P 500 is down, those other asset classes have been positive. So, when we say that those fixed income asset classes are a good buffer for stocks, that is really based on the averages.
2022 is a good reminder, too, that, I agree with Wes. I mean, it was definitely an outlier. I think 2022 was a year that surprised a lot of people. People know that stocks can go down. I think on the bond side, people were surprised. But one thing to remember is that in those instances that it's a loss, but it's a loss on paper, right? If you don't have to sell, if you don't need the cash, if you don't need, it's a rebalancing opportunity potentially from a planning standpoint. And as I think people have realized that we are in a higher rate environment, which means you can potentially get higher returns on your fixed income investments. So it was a shock for people, but I try to remind them that, hey, you didn't have to sell. It's just a loss on paper.
It's a great reminder. I think there's a lot of views out there of if I own individual bonds, like you're not losing money on those when rates go up. But the reality is it has the same impact on bonds in a mutual fund or an ETF.
That's a good point.
Right? Just, you only realize that loss if you sell on whether you hold them directly or within a fund or an ETF. I want to go back to one other thing here. Now, this is a little bit of a soapbox for me, and I think we should... No. Well, we know I have a lot of soapboxes. We should just get a little box and slide it out there.
Mark keeps like 5 of them there in the corner.
The comment of rates have gone up, and I want to go and connect this to mortgages. And I was talking to somebody last year, and they were in their 30s, and they're looking to buy a home. And they were saying, man, this is just a crazy market. Like mortgages have never been this high. Is really frustrated about, the cost then of servicing a home there goes way up there. Now you started chuckling. This idea if it's never been this high, and maybe in their experience it hasn't. But you go back to, and you guys are young pups relative to me, but my first house, I think it was 8-9% was the mortgage rate, and at that time it was, well, that's just what it is. Like there wasn't really an idea of it could go down to 2 or 3% because it's always kind of been higher in my experience there. So I think if you look at the long run data there from the Fed, 30-year mortgages have been somewhere in the high 7%, 7.7%, something like that. With where we are today, there's almost seems to be an expectation when you talk to certain people out there that, well, where the 30 years today, I think the high 6s, it might go back down to 3 or 4. I bring that up to say, be careful. If that's what you're expecting to do, that potentially could be a long wait.
Yeah, if we're saying we don't think professional money managers can predict when rates are going to go down, probably makes sense that a home buyer is not going to be able to predict when these things go down. And in the meantime, you're missing out on just the beautiful opportunity of owning a home and, having expensive repairs around the house. But no, it really is wonderful having a home.
Yeah, it's an interesting one. You do hear that out, be like, well, when rates come down. And look, rates are probably going to move, right? We know that they move around for many different factors, not just the Fed. We've already unpacked that. But, maybe 4 or 5% for the 10-year is where it'll be for a long time. We don't know. Now, next year, it could be at 2.5 or 3%. It could be at 7%. I don't have a clue what's going to happen. But the idea somehow that they have to come down, be careful going down that path.
All All right, we alluded a little bit to a joke about a low handicap. Jake, bring that back up there. I'm going to use it as a way to summarize the conversation today, which is, listen, a couple of key points. Can you time or predict interest rates? No evidence you can really do that consistently at all. Not all rates move together. Be careful which rate you're talking about there. But then a lot of anxiety comes into when you're trying to do those things and play that game. And just walk us through this low handicap strategy idea.
People look for these economic signals that give them some indication on what's going to happen in the future, what's going to happen in the market, and what I'm supposed to do with my money. And when you really start to dive into all of that, you could drive yourself crazy because one, we've unpacked that there's really no direct correlation of X happens and then Y. But when you do that, you spend so much time, so much anxiety. And what I brought up on the last one is that it's a high handicap strategy, meaning you have no time to spend on the golf course. So you're horrible at it, right? But you can extend it well beyond that, which is what do you have control over? What do you want to focus on? And I think for a lot of investors, when they get over that hump of, I actually don't have to predict, I don't have to analyze all these variables, I don't have to do all of that stuff to have a great investment experience, it's actually really liberating and frees you up to do what you want to in your life.
Great summary. Someday I'll get a lower handicap. It'll never be low.
I wouldn't bet on
It'll be lower. You've seen my golf game. All right. I want to highlight a couple resources here. Wes, is some of the things that you mentioned earlier. Just make sure you can go down and see these in our show notes. So here's a couple of the pieces Wes mentioned. It is a great title, by the way. Fed Forecasting Futility.
You like that alliteration?
That's a great one. And then the second one, Don't Get Fed Up, Part 2. So go down, look for those links in the show notes. And with that, a future hot topic we're reading about in the headlines is markets at all-time highs. Be sure to subscribe and enable notifications and have a fantastic rest of the day. Thanks for joining. Welcome to The Informed Investor, a show brought to you by Dimensional Fund Advisors, a global asset manager. Today's topic is the fascinating discussion around cryptocurrencies. I'm Mark Gochner. I'll be joined today by Jake DeKinder and Kevin Green. It's good to have you on the show today, Kevin.
It's great to be here, Mark.
Kevin's a PhD, integral part of our investment solutions group. So really, really glad to have you here today. Now, Kevin, we always start with headlines. So let me read a couple of headlines here and we'll get into it. All right, cryptocurrencies. First one, Bitcoin soared in 2024. How much, if any, should you own? And then another one here, have cryptocurrencies arrived as an asset class? It's complicated. And then, Jake, I have to go to our all-time favorite. Now, this goes back in time.
It's so good,
all right,
though.
We're going back to 2018 here. This is John Oliver on HBO's Last Week Tonight in March of 2018. Cryptocurrency. All right. Everything you don't understand about money combined with everything you don't understand about computers. What could possibly go wrong?
I mean, it doesn't get much better than that. But all kidding aside, I mean, I think that's a theme that pops up on these informed investors a lot, which is there are a lot of investment products that are out there. There's a lot of things that you have to understand about it as an investor. And I think you want to have a reasonably high degree of skepticism. We say this all the time when you go into this, especially when you start talking about, hey, is this going to impact the way that I'm going to retire or what I can do for my kids and all of those things? So all kidding aside, you do want to have that high degree of skepticism with a lot of things that are out there.
Whether it's cryptocurrency, stocks, bonds, really anything that you're thinking about investing.
That's right.
Just be very clear about what it is.
Not
you're trying
scared,
to accomplish.
not scared,
Yeah.
but maybe inquisitive.
Yep.
Yeah.
Yeah, that's a good word for it.
Yeah.
There.
Yeah.
And I go back to the headlines around the one about, should it fit my portfolio? And if so, how much and how do I think about that? So let's get into that here. But let's start out, let's just kind of higher level.
Yep.
We hear this term cryptocurrencies. Just maybe lay the groundwork a little bit. What exactly does that mean? How do I think about this term cryptocurrencies?
Yeah, I think we won't be able to solve all of the problems of thinking about what it combines with what you don't know about investing and what you don't know about computers. But I think it's helpful to think about what it is, right? And it's a digital form of currency. There's no coins, hard coins issued, no paper currency. It's not backed by a sovereign government, so it's issued by some independent party, and it's supported by this blockchain technology. And I I think about what this does, and it's basically a secure ledger. And I know you have an accounting background.
Now
Mark,
you got him excited.
Yeah, I know. This is going to be good for you. But if you think about, I think about balancing a checkbook before you had online banking. You have these debits and credits, and it provides a secure way to link all of the transactions as a part of the currency that gives you confidence in a way to transact and transparency into whenever you're buying and selling goods using this cryptocurrency. Now, the blockchain technology, it's important, I think, for many to separate that apart from cryptology and using cryptocurrencies, because the technology, the secure ledger, can be used in any number of ways beyond just digital currencies. You can think about companies using it to add value in their supply chains, right? Producing efficiency. There's examples of Walmart using blockchain to help track the supply of produce. When you have a foodborne illness breaking out, right, immediately almost, they can track where a particular produce, be it lettuce or something else, who supplied that. They can remove it from the shelves in a very efficient manner, whereas historically maybe that took weeks, or they lost out on a lot of goods that otherwise weren't tainted. So the technology is something that is prevalent in a part of your portfolio. Companies are investing in that. It needs to be distinct from the cryptocurrency, I think, for folks to kind of get a handle on what this is and what its role is, because sometimes the two get mixed without separating them.
Well, I was going to say, how long has it been around is what, because I think in the last 5 to 10 years, people have heard a lot about both cryptocurrencies. And I think for those that have read a little bit about it, they've read something about blockchain. But it's not necessarily just been around for the last 5 or 10 years. That's been around for a while, correct?
Blockchain has been around for a while. It's not a new technology per se, but there's been new innovations into how to implement it in day-to-day business. So I think that there's been an evolution in how to incorporate the technology in a way that's beneficial. But the technology of itself, right, it's been around for a long time. It's not something that's brand new.
Okay.
Should we set the landscape a little bit?
Yeah, I think so.
Good definition there of kind of the currencies as a whole, some of the background there. But, how big is it? Let's just talk a little bit about the landscape, and then we'll talk about how it fits in to one's portfolio. And it's hard to know exactly the number of cryptocurrencies out there. You can do a quick search out there, and something like 20 million may pop up. But if you do another search on that are actively traded on an exchange, it's somewhere between 10 to 20,000, I think, is sort of an accepted number there that's traded on an exchange globally. There's maybe about 1,300 plus exchanges out there where you can transact cryptocurrencies. Is that kind of how you think about the opportunity set there?
Yeah, it's pretty vast and complex in terms of the number of currencies out there. But when you start to look a little bit about which ones have actually gained traction and are being traded on a regular basis, it's a pretty narrow group. So it's pretty top heavy in terms of the coins that are actually capturing the majority of transactions and trading in the marketplace. You look at something like Bitcoin, which has a very long history relative to others.
The first, I'll say, real cryptocurrency out there.
Exactly, and that currently is around over 50% of the total market capitalization across all of these thousands of currencies that are out there, and then it starts to fall off pretty quickly thereafter. But you get something about the top 5 cryptocurrencies; those represent over 80% of the entire cryptocurrency landscape. So it's a very top-heavy industry, despite the fact that there's a lot of them out there. Most of the activity is limited to a few of the coins.
All right, Jake, we've gotten quite a few questions over the years, particularly around Bitcoin. It's one of the originals, if not the original, and the longest traded. So let me just give a couple numbers here and bring up the discussion of where we've sort of gotten these questions about cryptocurrencies over time. So I'm going to start with Bitcoin. And it really started trading, I'll say, around 2010. And it was in the pennies, and then it kind of got into the dollars and hundreds of dollars. A couple of major milestones as I think about the price movement of Bitcoin. 2017, in the year 2017 in December, it got up to almost $19,000. So it had a big run there in 2017. In 2021, it got up to about almost $68,000 per coin. And then it hit a record in 2025 of over 124,000. And then now it's somewhere around 108,000, depending on the day here. But Jake, we were getting the question big time when it was in that 67,000 range in 2021. Like, hey, this thing is skyrocketed, doesn't belong in my portfolio. And then guess what? A year later, it was down 77%.
And we've seen a lot of those drops through time, right? I mean, even if you go back, I think you said 2010 there, where we started really looking at the data there. It's funny if you look at some of the charts that we've looked at over time in terms of like, it almost looks like it's flat. And then back to 2017, you get this big spike. But if you actually go in and zoom, even back in like 2013, it's pretty remarkable volatility through time. And you compare that to something like, a basic U.S. stock index in terms of the amount of drawdowns, the big drops, all of those investment experiences look very different between something like the price of Bitcoin and something like a broadly diversified index in the U.S.
Well, let me give some numbers around that, and then I'll get your thoughts on this, Kevin. So if you go back in time, now here we're going back to August of 2010, when you really started to see some of the trading happening there on the Bitcoin. So if you go back to that time period, August of 2010, a loss of 50% or more for Bitcoin happened 6 times since that time period. For the Russell 3000, which is kind of a market proxy here in the U.S., we've never had a loss of over 50% from peak to trough. And if you look at a 70% drop from peak to trough, it's happened 5 times on Bitcoin, again, not happened on the U.S. market. So what do you make of those numbers there? How do you think about that volatility?
Yeah, that volatility is a bit frightening, and it brings up a more relevant question, I think, of kind of how does this fit into your portfolio allocation? When you see the storied rise of the performance of Bitcoin starting from trading at pennies to where it is, that can be attractive of thinking all the money that you could have made. But then you start to look at the volatility and think about what are the implications for that being a part of my asset allocation. And it also brings up the question of thinking about what exactly is represented by these digital currencies. Are they some form of a medium of exchange? Are they supposed to be a replacement for cash? Well, Jake, if I sell you something today and you give me US dollars for that amount, and then tomorrow if I see something...
Does anybody actually still carry? I actually do carry some cash, but a lot of people don't carry cash around anymore.
I do keep a little bit of cash on me for various reasons.
Definitely not coins, man. Well, the penny's like going away, right?
But the point being is if we have that transaction, then tomorrow the US dollar depreciates by 70%. Well, that's a little bit risky. That's not really what I'm looking at from the confidence of having a currency that provides a viable way to transact and gives me confidence.
Certainly. No, it makes a lot of sense. And I think that the volatility piece is interesting too, especially, you're talking about all of these additional cryptocurrencies that are out there. And now you're starting to see, I say, more diversified solutions that are coming to market. I mean, there's a lot of stuff that's in an ETF form. You can buy Bitcoin in ETF form. You can buy a lot of cryptocurrencies in an ETF form. But also do know that if you look, at what happens when you get the big drops in Bitcoin that you cited, a lot of times you get the big drops in a lot of the other cryptocurrencies as well. And I'm not saying it's a correlation of one across the board, but you do tend to see them move as a group. So something to take into consideration as well, even as people start arguing for, well, there's a more diversified way to do it.
We talk a lot about that volatility, the huge price swings up and down. But going back to then, if I think about it as an investment, so maybe not necessarily as cash, because
right.
maybe the price swings are too big to think about it as a cash replacement. But as an investment, how do you think about an expected return of a cryptocurrency?
Yeah, it's challenging. You compare it to the alternatives like a stock, and that's ultimately represents a residual claim on all of the future earnings that company is going to generate. Or you're thinking about a fixed income investment, you're lending money to an issuer, and in return you're getting interest payments. Those are tactable ways to think about formulating, I can get a positive rate of return for making this asset allocation decision, investing in a stock or bond. When you think of something like a cryptocurrency like Bitcoin, it's really driven more by speculation of thinking, I'm paying X price today, and if I'm going to get a positive rate of return, that must mean that I'm expecting someone else to pay more for this into the future without any direct link to a stream of income that you're generating from that to provide support for that fundamental valuation.
It's important too, we're talking there about sort of the overall allocation, and we work with a lot of financial professionals, and when they are trying to put together financial plans for their clients, right, you sort of form expectations out in the future. You got to have expected returns for different asset classes. And I ask them all the time, I'm like, if you had to put an expected return into your financial planning software for cryptocurrencies, like what would you put in there? And a lot of them struggle to come up with a reasonable number. And I think it gets back to there's just a massive dispersion of returns and a high degree of volatility. Then you combine that with, well, what would be the expected return really of any currency? And I think it's challenging to come up with a reasonable estimate. Whereas, you look at stocks, we've got 100 years of data. You can come up with a reasonable, and they're noisy, right? But a reasonable estimate for what you expect to make on your stock and bond portfolio.
Well, you always give the example, too, of if I have a U.S. dollar, a year from now it's worth $1 US.
Right.
If I have one Bitcoin, a year from now it's worth one Bitcoin. But what is that value?
You don't
right,
know.
You just don't know.
Right. And that's back to Kevin's point, too. Look, anything can happen with the U.S. dollar, right? We know the value of the dollar fluctuates relative to other currencies. But I think there's going to be probably a little bit, and when we've seen this, more volatility when you're talking about one form of currency versus something like the U.S. dollar or any other major currency that's out there. Well, the other thing, too, coming back to, thinking about it as an investment, thinking about the allocation, one of the things we talk about, which is, well, how much exposure do you already have to it, right? Either through companies that are doing blockchain and using that either in the blockchain business or using blockchain, or quite frankly, there's a lot of companies that just invest in cryptocurrencies as well. So it's hard to understand truly already how much exposure you might have to it.
Yeah, you have some.
Yeah.
You just don't know exactly
Right.
what that is.
Right.
Yeah, but it's a good point you made about if you're looking at cryptocurrency as growth and creating wealth, and we should just clarify that. I think a lot of the conversation we're having now is probably around that point. So it's hard to put an expected return on that long term because you just don't have the data and really know what that's going to be worth down the road. But one other thing, too, when we think about companies, we make this point a lot on publicly traded securities. Like, it's tough out there. There's so much competition.
Yeah.
And there's so much competition, I think, in the cryptocurrencies. And it's going to be interesting to see potentially if the sovereigns get into this. What if the U.S. comes out and says we have a digital currency too, or cryptocurrency? Like, what does that mean for the marketplace?
We're still in the early stages of kind of the development of this, we'll call it industry, and there's a lot of uncertainty of kind of what role regulations might have. Would sovereign nations issue a digital currency of their own, and what does that do in terms of the composition of this market? If you have a digital currency issued by the U.S. government, for example, what does that do for the attractiveness of investing in Bitcoin? Right? It's quite uncertain as to what ultimately could pan out, and there's that uncertainty should be foremost in many's minds as to thinking about what role or what kind of allocation they may want to this space.
All right, so we talked a little bit about the competition potentially that's out there with different cryptocurrencies. Another thing I think investors should be just aware of is, I'll say, the safety.
Yeah.
Of some of these cryptocurrencies. You're reading some different articles about potentially fraud and people hacking, I guess, the exchanges or the accounts. So just another thing to be careful of as an investor.
Well, I think you're right about that. There is this, I think, sense out there that cryptocurrencies are gaining legitimacy. You're reading about them more. You go back a couple of years ago and you've got celebrities that are out there, promoting different currencies, promoting different exchanges. Shoot, they're naming stadiums, right? It doesn't mean that just because it's becoming, I'll say, more well-known or more legitimate, there aren't serious risks that are still associated with that. And that goes back to the opening comment of you want to have a high degree of skepticism when you go into some of this stuff.
Yeah, I like to think about it as kind of monitoring costs. It's pretty cheap for me to monitor what's going on with my current allocation. How much effort do I really want to spend monitoring any type of allocation into some other asset class? It's just not something that I want to spend a great degree of my time on, and something I don't have to.
Well, we talked about that in a previous episode where we talked about public markets versus private markets. And again, that's a big consideration for you as an investor. What's it going to take from a due diligence standpoint so that you feel good about putting a substantial amount of your wealth into something like that?
Yeah.
Hey, you mentioned cost. I think that's one thing you always want to consider for any investment. Is what's the cost side of things? And we've certainly seen transaction costs. There's a cost to buy and sell a stock or bond. There's a cost to buy and sell a cryptocurrency, and I think that's come down over time. But what are some other costs to think about as you think about a cryptocurrency?
Well, one of the ones that you love to talk about is, tax cost, right? A lot of people that are moving in and out of cryptocurrencies, Bitcoin, whatever, and maybe even the ETFs that have been launched as well. There could be some potential short-term trading in there. When you're doing short-term trading, right, that's not the most tax-efficient strategy. So that's one to think about. The other one we love to talk about all the time is opportunity costs. And I know you love to bring that one up, right? Unless you have unlimited money, you got to pull it from somewhere. And what was the expected return of where your money was at? And what's the expected return now of going into something, a substantial portion is something like cryptos?
But then go back to the opportunity cost. So if I'm saying, okay, I'm going to go invest in a cryptocurrency, that money's coming from somewhere. So if it's coming from cash, okay, I kind of know what I'm earning on cash. If it's coming from my stock allocation, well, historically, we'll say maybe an expected return of a 10%. What am I going to get on that particular cryptocurrency? So that's kind of what you're meaning by the opportunity cost.
Completely. You always have to think about, again, unless you have unlimited money, right? You sort of have to say, if I'm taking it from one pocket and putting it in the other, or one type of investment and putting it in the other, what's the trade-off that I'm weighing in doing that? Now, through this whole discussion, I do want to be relatively balanced in that, you brought up 2010, right? And the reality is that this industry is evolving. Cryptocurrencies are evolving, the adoption of blockchain technologies, the way that investors can access either an investment in something like that. We cited the fact that you've got packaged in different ETFs that are out there, a lot of exchanges, much easier transaction costs to do the investments are coming down. So I do want to be balanced in that. It's just all of the things that you cited around, well, why am I holding it? What do I expect to make on it? What are the risks? What are the costs? It doesn't mean that those go away even as this industry continues to evolve.
Well, it's a good point about the evolution very quickly. I mean, there's tokens now.
Oh, yeah.
That are starting to be coming out. Can you start trading 24 hours a day on these different tokens on exchanges and things like that?
Well, the tokenization, basically a digital asset you're trading there for, what would be a share in a stock. I mean, again, that's another one where you want to be watching how this is evolving. And back to Kevin's point, that's another application right there of blockchain technology, not necessarily inside of a company, but in the investment industry and how that's evolving.
Yeah, it is a nice evolution. I think Mark also can point to the evolution of his art collection and the digital tokens that he has in terms of providing efficiency gains there. But no, many applications are getting aside.
NFTs.
Yes, exactly. Many applications. You're exactly right. That is a clear case of where the technology is being used as a way to provide potentially some form of benefit for investors, apart from the usage in a cryptocurrency format.
Now, just to be very clear on those NFTs, I never bought a picture of a monkey or anything. My model for investing is, if I don't understand it, I kind of stay away from it. And I still don't really understand all the intricacies of investing in cryptocurrencies, NFTs, or things. Jake, you were at a major industry event.
I was out at Future Proof.
In the last day or two, and there's a lot of conversations going around with cryptocurrencies and things. And you do hear about it. How do you think about it in terms of a growth strategy? How do you think about it in terms of cash? But another one we hear often about is, how do you think about cryptocurrencies as an inflation hedge? Sometimes you read about that in headlines. So maybe start with that, and then I'll get your thoughts on that, Kev, about inflation.
Well, the one thing to understand about a hedge is you basically want something that sort of moves in lockstep. And if you look at the volatility of something like inflation, US CPI over time, I mean, listen, you get spikes up, don't get me wrong. And we've seen a little bit of a spike up, in the last couple of years here. But if you think about inflation over time, it sort of moves like that, right? And if you think about what cryptocurrencies, or we'll just take Bitcoin, has done over time, it looks like this over time, right? You cannot hedge that with something like that. That to me is a different argument. That's an outpace argument, right? Which is, okay, I have something that I think is going to do better than inflation over time, which is fine, because a lot of people want to figure out how they maintain purchasing power and outpace inflation over time. But when I do hear, oh, it's an inflation hedge, I think you're a little bit off on that. That's not the way you hedge unexpected inflation.
Yeah, Jake, that's a good point. I think a lot of that stems from this idea that this is an alternative form of currency, so maybe it can protect against inflation pressure on a U.S. dollar or something else. But the main point is that when you truly want to think about a hedge, you do want it to move in lockstep to reduce or remove the uncertainty of what inflationary pressure might do to the asset you have exposure to, with U.S. dollars. And when it doesn't move in lockstep, rather than reducing uncertainty, especially when you see something as volatile as Bitcoin, you're actually increasing uncertainty in your portfolio. And that's pretty much the exact opposite of what the goal of a hedge is to do. And so you see that it doesn't really line up in the numbers. And it further speaks to this idea of if you're looking at it as a hedge, or even maybe as a diversification tool. Again, when you think about diversification, the objective there is to reduce uncertainty, reduce volatility. And when you're adding something that's as volatile as Bitcoin, that's not going to narrow the range of outcomes. It's only going to expand them and increase the volatility of your asset class. So whether it's as an inflation protection tool or as a diversification tool, a lot of those thoughts are really misplaced with what you see from a data standpoint of how this asset class performs and how it fit into and what it might do for your existing asset allocation.
You think about the availability of the cryptocurrencies out there. We talked about, maybe there's 10 to 20,000 that are traded on exchanges. And as this technology evolves, the opportunity set evolves, I'm sure some of these are just going to be potentially big winners. The hard part is to say, I don't know which ones, handful of that 10 to 20,000 are going to be the ultimate winners on this thing. And it's hard to diversify all 10 to 20,000 cryptocurrencies at this point.
Yeah, it's getting easier to do. There's definitely expanding number of products that are out there, but it's a really good reminder, Mark, that you made there. I mean, I'll go back to something as basically as like, the global equity markets. I mean, you go back and 35 or so years ago, I don't think a lot of people thought Japan as a country was going to be flat for 30 plus years in terms of their equity returns, right? And if you took a concentrated bet on Japan, you probably would have lost out on relative to a diversified portfolio. And that's a real basic example of diversifying across countries. But the concept is the same, that if you don't know which ones are going to be the winners, you have to be careful going all in on one.
All right, so if I'm an investor and I'm thinking, okay, I'm thinking about cryptocurrencies, just be very clear on what you're trying to accomplish, whether it's growth or inflation or cash. We talked about that. Have a good understanding potentially of what that expected return may be, know the risks, the costs associated with that. If you know those things and say, hey, I want to put some of my money in there, there's nothing wrong with that. You're clear on what you're trying to accomplish. Or it might just be, I don't know, I just want to participate. I want a flyer, ready to speculate a little bit. That's okay too. Or just be clear about that.
Yeah, it's a great point there. I mean, whether it's I'm going to put a little bit of money in there, and quite frankly, it's not going to change a single thing about my standard of living, how I'm going to retire, all the things that we talk about on this show. Great. Just don't be surprised if it goes to zero. Or I do hear people, to your second point there, which is I want to invest a little bit in this because I want to better understand it. And from an education standpoint, I'm okay with that. I mean, I'm not telling you whether to do it or not do it, right? But again, are you putting a large portion that's actually going to dramatically potentially change your outcome? Or are you doing it because it's a bet, I find it interesting, or quite frankly, maybe it scratches an itch. We say that all the time, right? If it scratches an itch and you're like, yeah, just interested, fine, whatever.
Yeah, Jake, I think especially you think about having a segment maybe of your allocation where you can make those types of decisions. You're fascinated by the topic. You can make an allocation to Bitcoin. You can make an investment decision for some other form of investment that falls outside of the broader structure of your portfolio. Especially if that keeps you in your seat for the long term, that can be a really healthy form of activity, right? I want a little bit of this because otherwise maybe I don't follow through with the long-term plan. And as long as it's not moving you away from that future trajectory, then it can be completely reasonable to think of having an asset allocation cognizant of all the trade-offs and considerations that we've discussed and still have a willingness to put some money to work in the space.
You told us you like to go to the craps table, right?
I do, yeah. I do enjoy it. That's a good point. I don't sit down at the craps table expecting that it's going to help me with retirement, but I am willing to allocate a little bit of my personal income to have a little bit of entertainment.
Hey, if I did, though, let's say I did want to allocate, not so much on speculation, but I do want it to be part of my portfolio. How do I think about how much should I put in, let's say, your cryptocurrency? So we talked about the landscape. I guess collectively, cryptocurrencies are about $4 trillion, somewhere in that range. It changes, depending on what the prices are doing. But relative to, let's say, the overall global stock market, what is that, like 2%, something like that?
Yeah, it's pretty small. You think about the overall stock market having somewhere around $175 to $200 trillion worth of both the global equity and fixed income assets across the world, and you compare that to something like $3.5 to $4 trillion in cryptocurrencies, and it's pretty small. And so you think about what type of allocation that you would want that allows you to be comfortable with your portfolio performing somewhat reasonably close to what you see from the overall asset, and it's small. Otherwise, you start to get a lot of tracking error, a lot of movements in your portfolio that makes you look a lot different, that can be challenging for someone to stay in their seat if they're having that type of disruption in their performance day to day versus what they're seeing elsewhere.
Well, by tracking error, let's say your coin's up 100% and your rest of your portfolio is up 10, or it's down 70% and your portfolio is up 10. That's what you mean.
Yeah,
tracking
exactly.
How different it can look versus your rest of your portfolio.
Everyone likes tracking error when it's on the positive side, but when you go through periods what we saw over the last 15 years where you have 5 drawdown events in excess of 70%, like that's exactly what most just can't withstand in their portfolio, and something that they should be top of mind when thinking about what's the reasonable size of allocation you might want to the space. And the reason was it's pretty small.
All right, so Jake, be very clear about what you're getting into. Know what you're trying to accomplish. The industry, the cryptocurrency is evolving fast.
Evolving very fast.
And we'll come back and give some updates on this as it continues to evolve.
Well, and one of the things too is I don't think that blockchain, right? It's companies are incorporating it. We're seeing it more and more in everyday life. That's just the reality of it, right? Cryptocurrencies have been around for a while now. We're not here making the argument that it's going away anytime soon. My point here is I do think it's something that as an investor and as maybe a financial professional, it's an area that you want to stay up on, because I think the discussion is going to continue. It just means be careful rushing in as an investor, I think.
As this evolves, we'll come back and discuss those evolutions and always have that conversation of how and if it fits in my portfolios, or just things to be aware of with that. So thanks for joining us today, and have a fantastic rest of the day. We'll see you on the next episode.
I hope you enjoyed this compilation of The Informed Investor. New episodes post on Friday, so please visit the Dimensional YouTube channel to subscribe, and thanks for watching.